We can only move as fast as, I guess, the slowest common denominator. And that's typically because it's a regulated high-scale bank. It's normally some aspect of how the bank needs to operate, either for compliance or legacy purposes. So it does feel a little bit like hurry up and go slow sometimes, which is definitely a level of frustration when you're trying to move at high velocity from an innovation perspective. We do deal with a multitude of different organizations. So on one side, we deal with the large global trade banks. And on the other side, we deal with close to startup sort of fintech companies who are trying to put innovative solutions in market. And it's partly to deal with that problem, so we can actually have some real showcases as to where the market needs to go. But critically, we made that decision because it's only the banks who actually have the skill to solve these problems globally today. If you look at the gap in the lending market that we talked about, that's been known for quite a while, and there's been lend tech providers who've been trying to close that gap outside of the banks because it's not heavily regulated for more than 5 years. Combined, they make up less than 2% of the overall gap, even today, because they don't have the scale. So we thought, well, how do you solve the problem at scale? How do you really make a difference on the economic landscape? And that's the thing, if you want to make a real impact at scale, then you've got to deal with the people who can scale, and that's the banks, and they can only move at a certain speed. So we tend to flip-flop between doing things which are highly innovative, sometimes with banks, sometimes with non-banks, but which can't necessarily be scaled across all of the infrastructure, versus doing what we call delta innovation, which is a much better or a digital version of something that exists today, which can be massively scaled and have an impact in terms of moving the needle for the bank in terms of revenue or market share. But it's a constant problem that we're trying to solve. And I think we'll solve that problem when we get to the next stage of engagement with most of our early customers, because that's where we're starting to build in network effects. And the network effects are that you're utilizing the platform as a true platform, not just as an infrastructure upgrade. What the difference is that the participants on the platform can interact with each other and figure out new ways to create value for each other, independent of what we do to drive new services in the market. So what does that look like? I believe that within 10 years, commercial banks will make more money out of supply chain transaction services than they do out of business sort of financial services today. So if you want to provide a shipment of widgets from where we are in London to Cape Town in South Africa, there's a whole bunch of transaction services which some straddle a line between financial services and some are pure trade transaction services. And in solving the trade financing problems, you have to solve the trade transaction problems. So why not solve all of them at the same time? And I think that banks will start to realize this and realize the perceived value add from their customers of solving these problems within the next decade. So I predict that within 10 years that banks will actually start to provide lots more of what are traditionally logistics type services, because it just makes sense. They've got the ability to do it and it's value added to their customers. So effectively they'll outsource some of these transaction services. So in that scenario where you're shipping widgets from London to South Africa, if you're doing it for the first time as a mid-market company, you don't have an infrastructure to do that. So what do? Do you hire a whole bunch of people to do that? Probably not, because you don't know if you've got repeat business. So you just basically consume the service via your bank. It'll be a bank-branded service. It's probably not something the bank manufactures as a service. It probably comes from a logistics provider. But they'll actually have this channel which can consume all of these different services, and that's the network effect. So the customer can find all the services that they want, and they can request different services through the platform which is provided by the bank initially for trade finance, but it'll be for supply chain transaction execution over time.